DST 1031 exchange properties are only available to accredited investors, generally described as having a net worth of over $1 million, exclusive of primary residence, and accredited entities only, generally described as an entity owned entirely by accredited individuals and or an entity with gross assets greater than $5 million. If you are unsure if you are an accredited investor and or have an accredited entity, please verify with your own CPA or attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, and or real estate. Such offers are only made through a private placement memorandum, PPM for short, which is solely available to accredited investors and accredited entities. Securities are offered through Phoenix Capital member FINRA SIPC. Phoenix Capital and K Properties are separate entities. This material is not to be interpreted as tax or legal advice. Please speak with your own tax and legal advisors for advice and guidance regarding your particular situation. There are risks associated with investing in real estate and DST Delaware statutory trust properties, including, but not limited to, loss of entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read the PPM carefully before investing, paying special attention to the risk section. Because investors' situations and objectives vary, this information is not intended to indicate suitability for any particular investor. Please speak with your own CPA and attorney to determine if an investment in real estate and or DST properties is suitable for your particular situation and circumstances. Past performance is not indicative of future returns. Potential cash flows, returns, appreciation are not guaranteed and could be lower than anticipated. Thank you everyone for listening in. And now I would like to turn over the call to our Senior Vice President, Matt McFarland with K Properties and Investments.
Thank you very much, Tommy, for the introduction, and more importantly, thank you to our listeners. We really appreciate you joining us today. We are going to be continuing the series that we've titled DST Essentials. Here we've taken an in-depth look at the recurring themes and nuances to the DST investment process. For those of you joining us for the very first time, this is done in an interview format where we have more of a laid-back conversation surrounding one of many of the topics that are involved with a 1031 exchange, and more specifically with the DST property. So really excited to continue this series today. Before I introduce our guest, I want to give just a little bit of information about K Properties. K Properties is a national Delaware statutory trust DST investment firm. Our platform, www.kpi1031.com, provides access to the marketplace of DSTs. This includes DSTs from over 25 different sponsor companies, custom DSTs only available to K clients, as well as active DST secondary market listings on occasion. K Properties team members collectively have over 130 years worth of real estate experience, are licensed in all 50 states, and have participated in excess of $30 billion worth of DST 1031 investments. Today, I'm very excited to have Alex Madden on the line with me. Alex is a senior vice president that heads up the K Properties Boston office. Alex is a leader and a specialist in the 1031 DST space and has vast 1031 exchange transactional experience. To date, Alex has helped investors purchase hundreds of millions of dollars worth of real estate. And prior to joining K Properties, Alex worked for KPMG in their management consulting federal authority practice, and prior to that served our country as a U.S. Army Ranger with multiple deployments to Afghanistan. So I'm very excited to have Alex on the line with me. And today we are going to be discussing how investors use Delaware statutory trust properties to replace debt. This is really, really important as it relates to a 1031 exchange, and one of the topics that investors commonly struggle with kind of wrapping their mind around. So without further ado, Alex, welcome to the call, and thanks for being with us. Absolutely. Thanks so much for having me on, Matt. It's always a pleasure to be back. It's good to have you. So let's jump right in. So I want to before we kind of jump into the mechanism of how debt is replaced in a DST, maybe you can provide context for why debt replacement is important in the context of a 1031 exchange.
Yeah, absolutely. And I think you kind of set that up very nicely because a lot of times I hear investors as we're talking, they'll say, I need to replace this debt, or they'll ask if they need to replace debt in an exchange. And while of course I understand what they're getting at, I always like to point out that the regulations, Section 1031 of the tax code, that's this like-kind tax-deferred real estate exchange, does not actually require investors to quote-unquote replace debt. And what it does require is that they purchase equal or greater value from what they sold. So when we're considering this, I think in practical terms, most investors are going to need to replace any debt that they have. That's kind of the easiest way to go about it in many ways, depending on your situation. But I think it's worth noting that, Matt, I'm sure you've had this. I've had a number of different clients over the years who have said, you know what, I don't want to take on any more debt. I'm just going to replace my own debt by adding my own cash and thereby getting back up to the equal or greater value. And then from time to time, we'll have some investors say, well, I have a 50% loan to value on my current exchange. And what I'll do, and they think that they're being very, very shrewd in doing this. Well, they'll say, what I'm going to do is I'm going to go up to an 80% loan to value, and I'm going to replace that full amount, and I'm going to pocket the difference, and just take that money and go do whatever I want with it. And that's also not permissible according to the 1031 exchange. You need to replace the full amount, the sales price, potentially the net sales price. I would discuss this with your CPA or your tax team. But you need to replace that sales price, and then you need to spend the full amount as well in order to have a full tax deferral. So when we talk about replacing debt, for example, we sold for $1 million, had a $500,000 mortgage. When that property sold, of course, you need to pay back the bank. So $500,000 is going to go back to your lender, to the bank. $500,000 is going to go to your qualified intermediary. And then to have a full tax deferral, we need to take the $500,000 with your qualified intermediary and buy at least $1 million worth of real estate to get back up to that sales price. And so that's what we mean by replacing debt, Matt.
That's super helpful. I'm really glad you started with that because I think investors really do get hung up on debt replacement, and it helps to understand the two requirements as it relates to value. It's really value. It's a value issue, right? The IRS requires investors to spend 100% of their proceeds, which is the cash that they generate from the sale, and two, to replace the value of what was sold, right? So that doesn't necessarily always mean replacing debt. They could add cash, like you said, Alex, and technically they don't have to replace full value. That would be a partial 1031 exchange. Obviously, there would be taxes, due in that situation. But I really appreciate, how you kind of frame that, and I think it's really important to understand in context. So I want to kind of move to the next section here, based on that foundation that you laid out. Maybe you could walk us through, Alex, how, debt replacement works. So specifically for an investor that is replacing a mortgage they had on the property with new financing. Can you walk us through how that would work in a traditional context and how this would be different as it relates to assuming debt in a DST?
Yeah, absolutely. So, when if you or I or any of our listeners here were going to go, get a mortgage on a property, so let's just say it's a single family home, there's going to be all of the bank underwriting, and I'm sure virtually everybody that on the call today has experienced this. But you need to list all of your assets and all of your liabilities. You need to provide bank statements. The bank is going to be underwriting you and any other co-signers. They're going to be evaluating your financial position. They're going to be asking invasive questions, and then of course you are going to be personally liable for that loan, which is to say, if something goes wrong or is unexpected, with the property that you're buying, you're on the hook for it. And if you don't fulfill your obligations as a borrower, then the bank or the lender has legal authority to come after not just the property that you're getting the loan on, but your other assets as well. And potentially, depending on various state laws, potentially your home, vehicles, other investments that you have. And so, that's what we call a recourse loan. And so as the borrower, you are personally guaranteeing that loan. And so it's, potentially a little bit more onerous, certainly a lot more difficult. Anybody that's going to walk through the whole underwriting process, it seems like there's an endless request for more information and CPA letters to explain this and that. And so that's kind of the traditional side of things. And then on the DST side of things, I often laugh because it's probably the easiest debt that an investor is ever gonna get from the Delaware Statutory Trust. And what I mean by that is, if there is a DST that has a mortgage on it, and not all of them do, but for those that have a mortgage on it and investors need to replace that debt, like we were just talking about, then that is already structured. It's already in place prior to the first investor coming in. And so when an investor purchases a Delaware Statutory Trust, they are purchasing what's known as a beneficial interest, or kind of just colloquially, they're purchasing a percentage ownership, a percentage of that property. And so when they buy that, they're investing their money, their equity, to buy that percentage ownership, and they're also getting that percentage of the debt as well. So it's typically a fixed interest rate. Usually we'll see a 10-year note. Not all of them, but you should talk to your registered representative about that. It's a very common note structure within the DST. And one thing that we want to keep in mind is that it's non-recourse. So you are not personally liable, and you are not on the hook for that. So your other assets, whether it's vehicles, your home, any other investments that you have, that is not at risk in the Delaware Statutory Trust. Now, it's important to note that, of course, you are risking what you put into the investment. So if an investor is making $200,000 investment into a Delaware Statutory Trust, that $200,000 is at risk, but they're not personally liable for it with those other assets and that necessity. Also, because it's already structured, because the loan is secured by the actual asset, also potentially by the sponsor company or the principals of the sponsor company, depending on the DST, then because that is secured and it's already in place, the lender is not asking any investors for their own financial information. And so you don't need to sign for it. From a loan documents perspective, you don't need to provide your financial information. You don't need to answer to the underwriters. It is all structured. It's all packaged prior to the first investor coming in.
Absolutely. And I think that's really important to be aware of, specifically in the context and confines of a 1031 exchange. As many of our listeners know, the 1031 exchange can be a very stressful situation and experience, especially the first 45 days that an investor has to identify. And so dealing with all these moving parts, going through the due diligence of various properties and various investments and balancing that with all of these lender requirements can be very onerous and very difficult in a more traditional exchange. The DSTs mitigate that by stripping an element of complication out of the equation entirely, right? And the fact that the debt is so easily and readily assumable in this context. And I think it's interesting to understand this and important to understand this based on how the debt is structured. And I think you did a really good job explaining that, Alex. It's structured on the institutional level, right? So these sponsors have already gone out and they've secured that financing on behalf of the DST and all the investors that initially will step into ownership of that DST. So they're doing all the work. They're doing all the working with the lender, going through all of those lender requirements in advance of putting that DST out into the market for investors to consider and potentially step into. So I think that's really important to understand. And there are benefits to it, right? I mean, a lot of these institutions, they have relationships that transcend any relationship that you or I would have as it relates to, different debt packages that they're able to procure different rates, on some of, with respect to interest and, able to structure more interesting kind of debt packages into the equation. And so one thing I want to say before we move on from this is I think it's really important to understand how the debt, interacts with the particular investment and why it's set up, in the way it is. And this is, not something we're going to dive into in this conversation, but would really encourage everyone to speak with their registered representatives on that topic. And maybe we can kind of, take a quick look at that in the sense of, Alex, I wanted to ask you, what are some areas that investors maybe need to be aware of with the debt? And this can be in and outside of the DST structure as they're acquiring, different real estate deals. I know it's kind of an open-ended question, but what are some things that you can maybe point to very quickly that investors should have top of mind with debt and pairing with real estate in general?
Sure. Yeah. I mean, I think this is a broad topic, about how to evaluate debt, how to evaluate the potential benefits and the potential risks of debt. But just to kind of rattle off a few, so much of it is going to be the terms, right? The colloquialism, the devil's in the details, right? What exactly are you getting? Is it a 10-year note? Is it a 30-year note? Is it a 5-year note? Obviously there's various risks there. Is it fixed rate? Is it variable rate? What is the interest rate? Does it go into floating rate at any point? And then you see, a lot of interest rate risk that's kind of unknown. Now within the DST, as I mentioned, we will typically, and obviously not everyone is like this, but probably the most common structure that we see, at least at this point in the market, is a 10-year note, and it's either interest only for the full 10 years, or it's interest only for the first 5 years, and it's amortizing after that. When you get into shorter notes there, shorter mortgages, there's a potential risk component, especially in the Delaware statutory trust, because there's not that ability to do a refinance. And so if you've got a 5-year note, that means, at the end of 5 years, you're going to be bumping up against a balloon payment. So we like to see those longer notes so that it has the ability to control the potential sale date. Where if you've got a 10-year note with maybe an exit strategy around 5 to 7 years, if something was to go wrong in the market, if there's a speed bump, hiccup, not a good time to sell, then that DST could just wait it out, right? And maybe 2, 3 years down the line might be a better time to sell.
that is potentially not, the primary business plan of what they were targeting. The sponsor company was targeting there, but better than facing a balloon payment and needing to fire sale an asset in order to get out from a loan, which is why we don't like to see those shorter loan terms. So I think there's probably a lot more to consider in the risk associated with debt, but it's definitely something to talk about. If you do need debt in your exchange.
Absolutely. Yeah, I appreciate you glancing over that. And you're right. This is a very deep and involved discussion with respect to kind of balancing that risk versus reward, which is not what we're going to get into today, but definitely a valid conversation to have. So I want to maybe, Alex, just wrap up the call with an example. I love, whenever I'm kind of learning about a new topic, I think examples can be really powerful. So would love to maybe just throw it out there to you if you can, maybe just provide a simple example of maybe an exchange that you've worked on recently, or if you want to just come up with, just a hypothetical, feel free to do that. But can you maybe walk us through how, a specific exchange scenario could translate into, a diversified DST portfolio, and taking into, debt replacement as part of that equation? I think that would be really powerful to end.
Yeah, absolutely. And I think I'll be brief here because I think I've got two kind of examples I'd like to share. One, I'll just use as hypothetical to kind of illustrate the point, and then I'll tell a real life story. But in a hypothetical situation, if an investor has a $1 million sale and they have a $200,000 mortgage on that property, so when that property is sold, they need to pay back the bank. So $200,000 goes to the bank, $800,000 goes to the qualified intermediary. Now, with that $800,000, they need to get back up to that $1 million sales price in order to have the full tax deferral. So let's say we have a Delaware statutory trust that has a 50% loan to value on it, and they invest $200,000 into that DST. Well, with that $200,000 invested at a 50% loan to value, they're actually buying $400,000 worth of real estate, right? Because they're contributing $200,000, that's 50%, and the bank is contributing $200,000. That's the other 50%. And so they now have spent $200,000, they've bought $400,000 worth of real estate, and they have $600,000 left with the qualified intermediary. So at this point, there's a decision to make. Would they like to take on more debt and, the potential risks, potential benefits associated with that? Or would they like to go debt-free with the remaining proceeds? Because at this point, they've replaced their $200,000 mortgage, and so they could buy another 3 DSTs, all debt-free, at $200,000 apiece. And there they have fulfilled that requirement to get back up to the $1 million to spend all of their proceeds, and they will have accomplished the 1031 exchange. So that's a hypothetical kind of scenario, and we will customize this here at K Properties. You speak with your registered representative. We'll customize this exactly to your situation, because I know that was kind of elementary, and I kind of went over it a little bit quickly. But the point is that we can work with you to make sure that you're replacing that debt. Work with your tax team to make sure you're getting that full tax deferral. So that's one consideration. And then I'll tell a real life story where I had an investor. He was I think he was doing about a $20 million exchange, but he wasn't doing the whole thing into DST. He had I think he had about a $7 million loan on this was a couple years ago, but he had about a $7 million loan on his relinquished property, and so he loved the non-recourse aspect
of the Delaware Statutory Trust. He loved how easy it was. And so what he did was he bought Delaware Statutory Trust to replace that $7 million in debt. And then with his remaining proceeds, he went and he purchased non-DST property. And he was a real estate professional, owned many different commercial properties all across the country. And so that was something that was kind of within his wheelhouse to do. But he absolutely loved just how easy it was to take on the debt, the non-recourse aspect, the fact that he wasn't going to have to be providing all these different lenders with all this information. So that was something that he evaluated as really worth it for him. And of course, we've had frankly the majority of our investors will just transition completely out of active management into Delaware Statutory Trust. But I think it's that non-recourse ease of replacing that debt within the DSTs is something that a lot of investors like.
That's super helpful. I like that last example because I think it really illustrates well the flexibility that DSTs provide investors, even if it's not for the entirety of the exchange, right? And as you mentioned, Alex, most investors that we work with, this is their primary option, and they are making that transition. But that really, to me, is one of the most powerful potential benefits is, and that extends to so many different aspects of this investment, beyond just the debt and how easy it is to assume it. But I really appreciate your time today. I think we'll go ahead and wrap it up here. We're approaching the half hour, but really informative, really helpful. Really appreciate all the great information you shared with us.
Absolutely. Thanks so much for having me on, man.
You're very welcome. And to our listeners, we hope you found today's conversation helpful. We do host this call live every Friday. We'll be off next Friday for the Thanksgiving holiday, but we invite you to join us on future episodes of DST Essentials with K Properties. With that, I wish everyone a wonderful rest of your Friday and weekend ahead, and a very happy Thanksgiving coming up next week. Thank you, everyone, and take care.
So if you visit kpi1031.com, you'll be able to log in for free access. And then also you'll get a number of different resources available to our investors on kpi1031.com. You get a free book on 1031 DST properties, so we'll send you a copy of that. A free subscription to the 1031 DST Digest magazine, which has all sorts of case studies, tenant overviews, educational resources and articles in the 1031 DST Digest. You'll get access to free educational 1031 DST conference calls. We host weekly conference calls every week with our investors on various topics in it regarding 1031 exchanges, asset classes, financing, debt-free, zero coupon offerings, different strategies to use when thinking about a 1031 exchange into DST properties. You get very, very educational conference calls. We'll get you access to those. Our team's here to help. We've done a lot of these DST transactions. We've helped thousands of investors nationwide complete 1031 exchanges into DSTs. We're here for you. Reach out to us at any time, and just really appreciate everybody taking the time to join us today.